Welcome to Chapter 2 of the Call Options course. In this chapter, we're going to look at Apple options, and we'll take 3 option examples and correlate them to our land examples that we used in Chapter 1. If you recall, we had a $1 million land option which was at the money, and we paid $25,000 premium for it. Then there was a $1.1 million out of the money option for which there was a premium of $10,000. And finally, we had an $800,000 in the money option which had a premium of $225,000. So these were the 3 different options that we saw in our land example. And in this chapter, we're going to look at Apple options and also understand how these options work in the real marketplace. But first, this is the option chain, option series for Apple. Apple symbol is AAPL. And on the left side here, you can see all the different option series that exist for Apple. The April weekly series has about 5 days to expiry. The May series has 26 days to expiry. So the number in brackets tells you how many days there are to expiry. So then we have a June series, a July series, August, and then it goes to October. And then we also have a Jan 2013 series that have 271 days to expiry. And finally, a Jan 2014 series that has 635 days to expiry. In general, you'll find that all major US stocks, US indices, ETFs, gold, etc. will have options that go out at least 1 to 2 years, if not more. So it's a very versatile, very flexible kind of an environment, and you have, as an investor, you truly have hundreds of options. So that's as far as the option screen is concerned. For our example, I'm going to consider the June series. So if you click on the June, it immediately shows you all the option positions for Apple for the June series that have 54 days to expiry. So this is the option chain for June for Apple. Now, if you haven't seen this course on the Thinkorswim platform, I recommend you see that right now, but I do have a course on the Thinkorswim platform. So please go through that and so that you can understand what the platform is all about. Here we have Apple options for June, and on the left hand side we know we have calls, so we're going to focus on the left hand side of the screen. In the middle we have the strike prices and the expiry month. So we have the June series and the strike prices of various options on Apple. So if we went back and thought about our land example, we know that we first considered a $1 million option that was considered to be fair value of the land at that time. And we said that that's an at the money option. So let's first try and correlate that option to a real option in the market today. So Apple's last trading price was $573 almost. So let's just say it was $573, and therefore the closest strike price to this price of Apple will be the at the money option. So you can see that 573 falls bang in the middle of 570 and 575. So for our purposes, both of these options could be considered at the money. So at the money really is just a concept. There's no real separator. We'll see that we have a separator here between in the money options and out of the money options. So if you look at this, we have a gray shaded area and we have a black shaded area. Any strike prices that are in the gray shaded area are all in the money, because these strike prices, if you look on the strike price column, they are all already Apple has gone above them. So it's like saying I want an option for the land at 800,000. Well, the price of the land is already at 1 million. Similarly, if what we're going to look at here is the 520 call. So it's the 520 call will be the in the money option because the price of Apple is already gone up above 520. So it's similar to saying the buyer of this 520 call is telling the seller that he wants the right to buy Apple at 520. Well, the price of Apple is already 573. So basically the difference between 573 and 520 is going to be the intrinsic value of that option. So this is the in the money option. This is the at the money option. And in at the money, in our case, because Apple is right in between two strike prices, we could consider either one of them as at the money. So in our example, we're going to consider 570. 570 is at the money. However, you'll notice that Apple is actually gone past 570. So even though we're going to say that this is at the money, it's technically in the money by about $3. And we'll see that as we go along here. So that's as far as the at the money options are concerned. You'll notice that the 520 call, which is in the money, is going for about $69, and the 570 call is going for about $38.50. So now, if you recall the land example, we had a out of the money option that was at $1.1 million. So that's similar to saying that I want the right to buy Apple at 625. So if you look at the 625 call option, it's going for $17.60, which is much less than this. And that's what you would expect because the $1.1 million option in the land was a much more of a risk for the buyer because the price of Apple has to go from 573 all the way up to 625, and then it has to go past that amount by this premium amount for the buyer of the option to break even. So the out of the money options represent much less probability of success, but if Apple does move all the way to 625 and beyond, the return on the investment is probably going to be higher. So this is much less than the at the money option, which is going for about $38. And then finally, we have the 520 call, which is going for about $69. So those are the three different options that we are going to analyze in this chapter. And in this chapter, we're only going to look at it from a buyer's perspective. Chapter 3 of this course looks at it from the seller's perspective. So from a buyer's perspective, what would the scenarios look like if we bought a 520 call and paid a lot of premium, or if we bought an at the money and paid $38.50, or if we bought an out of the money and paid $17.60. So those are the three scenarios we'll model. But before we get into that, I want to show you one more thing. So this is the option chain, and you'll have various ways you can customize your layout. So this is the last X is our last traded price of these options. That was yesterday. And the net change is the amount by which these options changed yesterday. This is the bid price and the ask price. This is the basic negotiation that happens. Now, we can change this layout. All trading platforms should give you an ability to change this layout. So I want to select my layout now and show you the intrinsic and extrinsic values for these options. So the moment you click on that layout, we can see that we have our columns have changed, and that's what it looks like. So focusing on the call side for now, we can see that anything above 573. So if you have a strike price above 573, then that strike price will be out of the money because Apple has not yet reached there. So anything above 573, the first one will be 575 and then onwards as you go down. You'll notice that the intrinsic value of this option is 0. Of all these options are 0. And that's what you would expect because they're out of the money. Apple has to go there to go to that strike for those options to have any intrinsic value. So intrinsic value of all out of the money or technically at the money also options are going to be 0. In our case, we've looked at 570, and as I mentioned before, it'll have an intrinsic value of $3 because the 570 call is in the money by $3. So that's what we're looking at, and you'll notice that as you go higher or deeper in the money, your intrinsic value of these options are going to increase. And you'll see the increase in the intrinsic value is very predictable. It's fixed. It's there's no ambiguity about them, because here it's $3, here it's $8, here's $13, $18, $23, $28. So it's increasing by an amount of 555. And that's what you would expect, because there is no ambiguity about what the intrinsic value of an option is. Where the ambiguity, or where all these option pricing calculations come in, is to calculate the extrinsic value of the option. Okay, so if you look at a 570 call, it has an intrinsic value of $3 and an extrinsic value of $35. So even though this option is slightly in the money, you'll see that 90% of the value is all extrinsic value. On the other hand, as you go up, so let's look at the 550 call. The intrinsic is 23, the extrinsic is 26, so the total is about 49. So 23 out of a total of 49 would represent about 40-45% of the value. So in this case, the value of the 550 call option is about 45%. The intrinsic value is about 45%. Now let's go a little bit more deeper. Let's look at our 520 call. Our 520 call has an intrinsic value of 53, because if you add 53 to the strike price, that's exactly how much the option is in the money, because that's where Apple's trading. So $53 as a percentage of $68, which will be the price of this option, that works out to almost about 75%. So you'll see that as you go deeper in the money, the percentage of the intrinsic value will increase and the percentage of the extrinsic value will decrease. And there are reasons for that, and there are implications for that. I don't want to get into that because we've not introduced time decay, but I just want to make one point here so that you can keep it in mind. These percentages are important, and because when we touch upon time decay later in this module, you'll realize that time decay only impacts extrinsic value. Time decay has no impact on intrinsic value, and that should be somewhat intuitive, because the intrinsic value is the true value of this option right now, because Apple is already above the strike price, so it has a basic value, and that value cannot be destroyed by time decay. As long as Apple is at 573, this 520 call will always have $53 as an intrinsic value, even if the option were to expire today. So that's exactly what the intrinsic value is, and it cannot be destroyed by time decay. So time decay only destroys the extrinsic value. So how much extrinsic value there is and what is the percentage of extrinsic value as expressed as a percentage of the overall value becomes important when we study time decay. So that's as far as intrinsic and extrinsic values are concerned. Obviously, anything that is out of the money has no intrinsic value, and all we have is extrinsic value. And you can see as the option goes deeper out of the money, its value is also going to reduce because Apple has to move higher. So the burden of movement is on these out of the money options, and therefore they're considered a bit more risky, a bit more speculative. If it does end up moving there, it'll probably be quite profitable. So now what we're going to do is look at these three options, understand its profit and loss profile, and go from there. So I'm going to select the first one, which is the 570 call, and we are a call buyer. So if I click that, it'll immediately populate my order entry screen. I'll change the contract to one contract. What we're doing here is we're buying a single option. It's a buy as opposed to a sell. It's one contract of Apple, the June series, 570 strike price, call option. We have only two options, calls or puts. We do the call, and we are going to pay $38.80 per share. So we have one contract. We know that options are traded in contracts, and each contract is is equivalent to 100 shares. So per share we pay $38.80. So for 100 shares, we'll have to pay $3,880, and that's exactly what your buying power effect here also shows. The broker will hold $3,880 from your account to cover this position. Now, so for 100 shares, we paid $3,880. If you were to buy 100 shares of Apple today, you would pay $573 per share. So for 100 shares, that works out to about $57,000, $57,300 to be exact. So you can see leverage at work. So this is the principle number 2. Whenever you buy an options contract, it is a leveraged instrument, and your investment into the position is going to be much less if you are an option buyer. For 100 shares, we can control 100 shares with $3,880, whereas if you were to go and buy a stock, the Apple stock, it would cost you about $57,300. And this is generally going to be the case with all options. When you compare it to stocks, you'll notice that the option is going to use much less capital, and that's where the leverage component comes in. Let's look at this option, and the first thing we have to do whenever we are thinking about an option trade is to be able to analyze this particular trade. So once we have the option here, we can click on the risk profile, and there it shows you. This is the risk profile of the 570 call option, which is at the money. So let me just explain this. You have 3 different lines here. I'll come to that later, but we're looking at the middle line where it says live. Okay, and if you come all the way down, it tells you that you have it's going to hold a buying power of 3,880, and this is you don't have a profit yet, but because of the differences in bid and ask prices, you'll see some numbers here. And here we have the Greeks for this. Now, we also haven't covered the Greeks. These are very important. It's coming later in this module. But let's just look at this call option for what it is. And so far, what we've seen is the profit and loss profile. So if you recall our diagrams, we have limited losses on the downside, and exactly at 570, the strike price, the P&L graph starts going up, and then we have unlimited profits on the upside. So let me explain this P&L diagram again. On the x-axis, we have the price of Apple. Here we can also customize this. We can move the scale and do all kinds of stuff. But let's leave it at this, and you'll see that whenever you're looking at a P&L diagram, you're going to be looking at 2 different lines. One will be a colored line. In our case, it's a red colored line, and the other line is a white line, and I'm going to explain both these lines, and these are very important. So let's get to it. The red line represents your position on the day of expiry. So we look at these 2 different numbers here. Okay, one is in white and one is in red. The red numbers are for the red line, the white numbers are for the white line, obviously. But the red line represents the status of your position on the day of expiry, and the white line represents the status of your position today. It could be very similar to what it is tomorrow, day after, and things like that. So your white line is your real-time line. Your red line is your profit and loss position on the day of expiry. So in our case, the date of expiry is 6/16, so June 16th, because we had about 55 days for this option to expire. Now, we can see whenever we have a change in direction of the line, whenever we are looking at P&L diagrams, whenever we have a change in direction, that means we have a strike price at that point. And that's exactly what we have. We have we are analyzing one contract at the 570 strike price. So Apple's price is currently 573. So that's the red dotted line that you see here. This strike price of 570 is where we have our position. Let's think back to our land options. So the 570 option is similar to the $1 million at the money option in the land. In that case, we paid a premium, the buyer paid a premium of $25,000 for this option. So he needed the price of that option to go higher by at least $25,000 for him to be financially profitable from that deal. So similarly, if you recall, we paid $38.80 here, our strike price of 570, which was at the money. And so our break-even price is going to be this 570 plus this $38.80. So that's exactly what we see over here. And if you look at the price here, it's 608, and that's what you would expect because we paid 609 almost. So because we paid almost $39. So 570 plus 39 is 609, and that's exactly what the platform does for you. You break even at that point because this is the zero line. This is the zero line. It's a horizontal line. Anything above the zero line on the y-axis is profits. Anything below the zero line will be losses. So depending on where Apple ends up on the day of expiry, the red line will tell you what kind of profit or loss you'll have. Okay, so if Apple goes up to 670, then we have a profit. Look at the left corner, bottom left. You'll have a profit of 6,137. If Apple expired at 590, which is in between the strike price and your break even, so you're going to have a loss. So that loss will be 1,883. On the other hand, if Apple crashes all the way, it doesn't matter how much it crashes because your losses are capped beyond a certain point, beyond what you pay for the option. And so here we have a max loss of 3,880. You can't lose more than 3,880. That's your maximum loss as a buyer of this option. So, and that's exactly what you see. If Apple expires anywhere below 570, your max loss is going to be 3,880. Let me now explain the white line. Okay, so let's say we got into this option today. So we bought this one call option at the strike price of 570. So the red line is good because it tells us where the option position will be on the day of expiry. But really what's important to us is also what happens between now and then. So how do we analyze or simulate that? And that's exactly what the white line is for. So the white line tells you what will happen today. So for example, if today Apple, once after you get into this position, if Apple goes from 570 to 590, you'll see that the white number now has a figure to it. So it moved up by $20 and you're going to make a profit of approximately $1,000 on this position. And similarly, on the downside, if it moves down by about $20, you'll probably lose close to $1,000. But as you go down further, your losses will be capped, and at some point, we know that it cannot exceed 3,880. However, on the upside, we have plenty of room, and anything past our break-even point, we're going to see a lot of profit. So if Apple goes up to 650, then we have a profit of over $5,000 on this particular deal. And the white line tells you what your profit will be at that point. Now, it's also important to understand how the white line works in relation to the red line. So as we move forward in time, so as every day passes, the white line will actually start collapsing onto the red line. So what I mean is this, we can simulate our trade at the bottom corner here. So we have a date of 4/21 here. I'm just going to move these dates forward by each day and keep an eye on the white line and see what happens to the white line. The white line will ultimately collapse onto the red line. So we'll see that. So you can see the white line moving as I move the dates up on a daily basis. And finally, when we approach June 16th, you'll see that this is on June 15th. It's the last day before expiry. And on June 16th, you won't have a white line at all. The white line would have collapsed onto the red line. And on June 16th, all you have is the red line, because that option is going to expire that day. And that's it. That option is gone forever. So that's how this works. We can simulate various things here, which we'll be looking at in detail in all courses. This is a fantastic analytics and simulation model. This is extremely important for everybody to see where your trade is going and how it will perform. So that's as far as the 570 call is concerned. So the thing to bear in mind is, you don't have to wait for expiry. If Apple makes a move in the direction that you want it to, then you're going to see immediate profits, perhaps in a day or two. So if Apple moves $20 tomorrow, which is very possible, you'll see a profit of $1,000. Now, always in any option position, the way you look at profit is as a return on your investment. So if you look at your investment was $3,880, so a $1,000 profit is approximately 25% of your investment. So that's 25% return in 1 to 2 days if Apple ends up making a move like that. So that's a great return. So we need to understand, you need to know when to take your profits and things like that. So those kind of details we'll also be looking at in various courses. Now, bear in mind, the downside is also the same. If Apple moves down by $20 tomorrow, you are going to lose the $1,000 also. But since you've bought this option, your losses are capped. So if you can withstand a little pain and wait for Apple to bounce back between now and June 16th, you could potentially make a good profit. But that's the good thing about being a buyer of options. Your losses are capped. And like I said, here we chose the June expiry, but we could have chosen July or October or January. Obviously, you're going to pay a little more for options that are further out because your extrinsic value becomes more, because that's time value. So you are going to pay more as you go out in the future, but you have a lot of time working for you. So that's as far as the 570 at the money call. Now let's look at the 625 out of the money call option. Immediately you'll see that the graph has changed now, and where the red line is changing is now at 625. So this is like our $1.1 million option for the land. The premium for that option was $10,000. So for the buyer, the price of the land had to go from 1 million all the way up to 1.1 million, which is the strike price, and then further by an amount of the premium. So this is similar to that example. Apple is currently at 573. It needs to go all the way up to 625 and then by an amount of the premium paid. Now, since this is an out of the money option, we're going to pay only $18 a share. So for 100 shares, we're going to pay $1,800, and that's exactly what the buying power effect is showing you right here. So if we add the $18 to the 625, and we'll see that our break even is going to be at 643. On the day of expiry, this is if you look at the red line, that will tell you how much profits or losses you'll have. But between now and that time, we look at the white line, and the white line tells us what kind of a profit or loss we'll have. The problem with the out of the money option is that the price of Apple has a lot more to go before it can become profitable on the day of expiry. We saw that in the at the money option, Apple had to come to about 629, if I'm not mistaken. I'm sorry, 609. So that was at 609, whereas here it's now 643. So out of the money options are less expensive, but they are also less probable in terms of success. But if Apple ends up moving there, then your out of the money options is probably going to give you a higher return because your investment is much less. So this is how we look at the out of the money option. Max loss is capped at $1,800. So you can't lose more than $1,800 on this option. And your current daily real-time graph, real-time position, will be shown by the white line. So now we look at the in the money option, which was at 520. So all I need to do is come here and change my strike price to 520. Immediately you'll see that the price of that option is $69.70. So we are going to pay, for 100 shares, we're going to pay $6,970. So your buying power is being held back by your broker. That's for $6,970. But even though we are paying such a high amount, you have to realize that a lot of this option value is actually intrinsic value. In fact, we saw that the intrinsic value is $53 out of the 69, so which was about 70% is intrinsic value. So that's good and bad in a way. It's bad because your option prices are going to move very fast because your intrinsic value is going up by $1, but if Apple starts going down, your intrinsic value is also going to go down. For every $1 move in Apple, your intrinsic value is going to go down by $1. Your profit and loss position is going to move very fast when you have an in-the-money option. So that may be intuitive at this point, but if it's not, that's perfectly okay. We'll be looking at these kind of details as we go along. You'll see on the P&L diagram, you'll see that the 520 call falls right here. Apple is at 573, so this option is already in the money. It's exactly in the money by this $53 right here. Okay, so if you add the premium to the strike price, that will be the break-even point for this option. So we have a premium of $69. Let's call it $70. So 520 plus 70 will be your break even, which is approximately 590. That's exactly what we would expect. So the good thing about the in the money option is you can see that Apple's right here at 573, and all it needs to do is to move up to 589 something. So in the money options have the best chance of becoming profitable. So it's got very little move to make, and also it'll move very fast. So we'll compare all that later. But so if you are right in your call, which means Apple is going to go up, then your in the money options will work very well for you. However, if you're wrong, your in the money options will also produce more losses than the others. That's the pluses and minuses of all three options. We've looked at this from the perspective of a buyer. And what we're going to do in the next chapter is look at the same three options from the perspective of a seller. In terms of the platform, it's very simple to model both the buyer and seller positions because all we need to do is change the buy to the sell, and boom, you'll see the reverse graph. And that's the graph of a seller of a 520 call option. But we'll get to that in the next chapter. So that's as far as chapter 2. If you have any questions, please email me at info@hackertrading.com. Otherwise, I'll see you in chapter 3 of this course. Thank you.